Hey, welcome back everyone. This is Uncle Frank, and I am not a financial advisor, nor is any of the content to be construed as financial advice. This channel is for entertainment purposes only. All right, guys, let's first take a quick peek back at last week's action, and then let's prepare for the action ahead. The S&P posted a 3-week win streak on Friday, though Wall Street's bull market stalled on Thursday and Friday. The biggest highlight of the week was chipmaker Nvidia becoming the world's largest publicly listed firm by market cap, a combination of mixed economic data and profit taking ahead of a massive $5.5 trillion options expiration event tempered the S&P's weekly gain. However, the benchmark index still achieved a significant milestone in surpassing the 5,500 point level for the first time ever. For the week, the S&P added 0.6%, while the blue chip Dow climbed 1.5%. The Nasdaq was flat. This edition of Wall Street Breakfast had plenty to say about potential swan events this weekend. The world risks entering a dangerous new phase as nations pick sides amid soaring defense spending and the stockpiling of weapons. On Wednesday, Russia and Pyongyang signed a treaty that outlined a mutual defense pact that would assist either nation if one was attacked. Meanwhile, NATO's Jens Stoltenberg revealed consultations on putting nuclear warheads on standby and pledged to boost the number of NATO troops on high alert by more than sevenfold to over 300,000. Elsewhere, the threat of escalating Houthi attacks on ships in the Red Sea pushed insurance costs higher and fueled calls for an expansion of defense forces. Under the heading Red Ink, the federal budget deficit is expected to swell to around $1.9 trillion this year, according to the CBO, which was higher than its previous estimate of $1.5 trillion. This takes into account increased spending for student loans and Medicaid, as well as the recently passed $95 billion foreign aid package. National debt is even poised to top $56 trillion over the next 10 years, or 122% of GDP, surpassing the 106% seen in 1946 after World War II. Meanwhile, the Eurozone is facing debt issues of its own, with the ECB warning 8 of its members, including Belgium, France, and Italy, over their excessive budget deficits. The politicians in power will make any promise to maintain that power and pay for it by borrowing and printing more, especially in an election year. It would seem that our policy to assist Ukraine is limited only by our desire for Ukraine to continue to conceal the secrets of our U.S. politicians. This is what it's all about this week, guys. Week ahead, U.S. inflation data could bolster case for Fed rate cut in September. The U.S. Fed Reserve's preferred measure of inflation is expected to show its coolest monthly reading since late 2023, offering hope that policymakers could start lowering interest rates in September. Economists forecast the PCE price index for May, due to be published on Friday, to record no monthly change, while the core measure, stripping out food and energy, and that's designed to provide a better picture of underlying inflation, is expected to see a 0.1% gain. Although both the overall and core measures are expected to be 2.6% annual advances in both, the projected rise in core inflation would still be the smallest since March of 2021. Fed officials held interest rates in a range of 5.25% to 5.5% for the 7th straight meeting earlier this month. Policymakers have noted encouraging progress on inflation readings like the CPI, but they are still looking for signs of longer-term improvement. So guys, what I'm hearing is the usual Wall Street bullshit. It could be higher, which we know is bad, but less than forecasted, and this is by the same people that want the rate cut, right? Or, my other favorite, the rate of increase is slowing. I wish this kind of logic worked with my dad and a bad report card back in the day. My grades are worse, Dad, but the rate that they're dropping has slowed significantly. Washington and Wall Street is again asking us not to believe our own eyes when it comes to the prices at the pump or the grocery store. And while I'm hoping for a rate cut to give home buyers and people with credit card debt a fighting chance, the fact remains that inflation was not transitory, and they should have never let it out of the bag in the first place. What we're looking for is a hot or cold number here, guys, but I don't trust these people anymore, and I'm sure the people we trade against already know the results. Call me a cynic. All right, there's the calendar slide. Let's get ready for the week. You know what I cover on this channel: the overall markets, the economy, corruption on Wall Street, and of course what I'm trading: AMC, GameStop, Archer, XRP, and the VIX. So far, I see 7 Fed officials scheduled to speak this coming week. Everyone will be listening for hints on the next rate cut or any hawkish comments that could delay it. Tuesday, June 25th, 10 a.m. Eastern Time, consumer confidence. Wednesday, 10 a.m., new home sales. Thursday, 8:30 a.m., initial jobless claims and GDP, second revision. 10 a.m., pending home sales. And 9 p.m. Eastern Time, the first Trump-Biden debate. At the time of this recording, we're about 134 days out from the next election. And then Friday, June 28th, the entire PCE group of data gets dropped. That's the Fed's favorite, along with personal income and spending, all at 8:30 a.m. Eastern Time. Moving to the earnings calendar for this coming week, there are some major names on tap: the world's largest cruise line operator, Carnival, and global economic bellwether, FedEx, will report quarterly results on Tuesday, followed by Betty Crocker and Cheerios parent, General Mills, and memory chip maker Micron Technology on Wednesday. Pharmacy chain Walgreens Boots Alliance and the world's largest shoemaker, Nike, will report on Thursday. Now, this is a new feature on the show. I hope you guys enjoy it. We're going to identify and name our potential white and black swan events that pertain to us and the apes and things we trade. Remember, what could be interpreted as a white swan for us can easily be a black swan for our enemies. Plus, one swan can easily spook another into landing. So we'll add to this list as we go along. Right now, I've got 2 categories: geopolitical and systemic financial. So under geopolitical, obviously, the Russia-Ukraine conflict. Now, if we go to the peace tables, that could be a white swan. But if Russia turns Kiev into a parking lot, that could be a black swan. You see how that works? Then there's the China-Taiwan and the rising tensions there. We've got Israel, Gaza, and that could easily include Iran at a moment's notice. And now the 2024 election. Under systemic financial, we've got the commercial real estate crisis. That really hasn't gone away. We really haven't dealt with it yet. I see 282 U.S. banks at risk. And then there's the BRICS de-dollarization trend. And of course, the $34 trillion U.S. debt spiral. Now, we could get a Ryan Cohen announcement. How is that not a white swan? Or another roaring kitty post. We could get the settlement of the SEC versus XRP case. Then there's what I call the derivative tsunami, or unrealized losses with the Fed and U.S. banks. Then there's the hedgy, hidden over leverage, securities sold yet not purchased, unreconciled synthetic shares. Now, in the comments, put the ones that you want in there on the list. Do you guys remember we covered the Chinese dumping a record amount of bonds last month? China ramps up de-dollarization by dumping a record amount of U.S. bonds. China sold a record $53.3 billion worth of U.S. Treasuries and agency bonds last quarter as it accelerates diversification from dollar assets. Well, I have more good news. Japan dumps $63 billion worth of U.S. bonds. The Central Bank of Japan is following the footsteps of BRICS and dumped $63 billion worth of U.S. and European sovereign bonds. And then from Bloomberg, Xi and Putin score wins as more Asian leaders want to join BRICS. The important thing to note here, guys, is these are U.S. allies dumping our bonds and trying to dump our dollar by joining BRICS. This is bad. On topic, China ramps up invasion fears as Xi delivers disturbing threat to Taiwan. Beijing has escalated the already fraught situation with Taiwan by issuing a chilling threat to those championing the island's independence, declaring that such individuals could face the death penalty. In an alarming statement, China's government has made it clear that it will impose the ultimate punishment on diehard leaders and activists who are pushing for Taiwan's separation from the mainland. Uncle Frank doesn't believe in doing business with your sworn enemies, communists in particular. This is how leftists, socialists, and communists deal with their problems. They kill them or put them in camps. The Chinese have nearly 2 million people in internment camps. Where's the outrage from the left? It's so quiet out there. Well, at least the big bank CEOs got their bonuses before this headline dropped on Friday. Regulators hit Citigroup, JP Morgan Chase, Goldman Sachs, and Bank of America over living will plans. Banking regulators on Friday disclosed that they found weaknesses in the resolution plans of 4 of the 8 largest American lenders. The Fed Reserve and the FDIC said the so-called living wills of Citigroup, JP Morgan Chase, Goldman Sachs, and Bank of America filed in 2023 were inadequate. Regulators found fault with the way each of the banks planned to unwind their massive derivatives portfolios. Derivatives are Wall Street contracts tied to stocks, bonds, currencies, or interest rates. Okay, guys, it's time to discuss this. As usual, I will give you both sides of the argument. I'll give you my take and then leave it up to you to decide. I can't give you investment advice, but I can recommend you go read this article for yourself and develop an opinion and a plan immediately. This is in the Cryptopolitan by Jai Hamid. America's debt disaster will either boost or break crypto. America's ever-growing debt problem is a ticking time bomb that could either push the crypto market to record-breaking heights or bring it crashing down. The Congressional Budget Office, or CBO, recently projected that aid packages for Ukraine and Israel, combined with other factors like student loan forgiveness, will push the U.S. deficit to a staggering $1.9 trillion this fiscal year. This ballooning deficit, coupled with a shift towards short-term financing, has some major implications for the U.S. economy, money markets, and the fight against inflation. On the pro-crypto side of the argument, one key way America's debt problem would benefit the crypto market is through its impact on inflation. As the debt grows, there's a risk the government will resort to printing more money to service this debt, leading to higher inflation. Due to their limited supply, cryptocurrencies are viewed as a hedge against inflation. If inflation rises, more investors might flock to crypto as a safe haven. Another factor is the potential loss of confidence in the fiat currency. As the U.S. debt climbs, faith in the dollar could wane, prompting people to seek alternatives. With their decentralized nature and through stablecoins, cryptocurrencies will become more attractive as both a store of value and a medium of exchange. This would bring a significant increase in crypto adoption and investment. Jai Hamid continues, global economic instability is another concern tied to rising debt levels. When debt reaches unsustainable levels, it will lead to geopolitical and economic uncertainty. In such scenarios, investors often seek out safe havens. Crypto, not being tied to any single nation's economy, would benefit from this. Institutional investment is another aspect that could also see a boost. As traditional financial markets become riskier due to the U.S. debt situation, more institutional investors will be tempted to diversify their portfolios by including crypto assets. The trend has already begun, with several major financial institutions knee-deep in crypto. If the debt situation worsens, this trickle could become a flood, boosting the crypto market in ways we've never seen. Now Jai brings the other side of the argument, breaking crypto. America's debt problem could also spell disaster for the crypto market. One major risk is a regulatory backlash. As governments struggle to manage rising debt and economic instability, they will consider placing stricter cryptocurrency regulations to control capital flows and maintain economic stability. That would stifle innovation, reduce market liquidity, and create major barriers for new entrants. Market volatility is another concern. The uncertainty surrounding the U.S. debt situation would increase volatility in all financial markets. Cryptocurrencies, known for their wild price swings, might become even more unpredictable. This heightened volatility will reduce overall market participation and lead to a crash. In the middle of a liquidity crunch, investors will be forced to sell off their crypto holdings to cover losses in other areas or to access cash. The mass sell-off we would see if that happens would be unprecedented. Here, Jai adds an interesting wrinkle to his analysis. The impact on the tech sector is another factor to consider. The crypto industry is closely linked to the tech sector and the broader U.S. stock market. If economic conditions worsen due to high debt levels, investment in tech and stocks will dwindle. This reduced investment will indirectly affect the growth and development of crypto projects, slowing down the entire industry. Adding to these challenges is the size of the Treasury market, which has quintupled since the 2008 financial crisis. As the deficit rises, the U.S. Treasury finds it increasingly hard to finance through long-term debt without causing an uncomfortable rise in borrowing costs. The change to short-term debt will disrupt money markets and complicate the Fed Reserve's efforts to control inflation. Money market funds, which invest heavily in short-dated debt, remain big investors in Treasury bills. However, with the Fed Reserve pulling back from the market, the balance between buyers and sellers of U.S. bonds is fundamentally changing. Then Jai wrapped his argument here. The question of who will buy all the debt on offer has plagued economists and analysts for months. If demand for U.S. debt decreases, borrowing costs could rise sharply, further straining the economy and making the debt problem even worse. This will lead to even more economic instability, driving investors to seek refuge in cryptocurrencies. However, if the governments choose to respond vindictively, the market will break. But they probably won't, right? I've always believed that one day there could be a great reckoning in the crypto space, a thinning of the herd, so to speak. There are all kinds now, utility, AI, gaming, meme, etc. But down the road, a time could come if your favorite crypto project doesn't provide something or perform somehow, some type of utility, it may vanish to under a fraction of a cent, and that could be permanent. I've also suspected central banks and governments will view crypto as a competing currency to their own and will only adopt CBDCs to cover over huge policy mistakes, undisciplined economic policies, and to assist in cleaning up or covering up a huge financial crisis. My attitude toward cryptocurrencies is evident in my portfolio as I only own and trust one, Ripple's XRP. I believe after the world begins to use this coin for cross-border payments, it will grow beyond the control and influence of just the United States government as it performs its tasks flawlessly while also unlocking trapped liquidity, which makes it vital to all economies around the world. My view on blockchain is less speculative. I believe that technology is the future, and I will now play comments from the 43rd Treasurer of the United States for her take on the matter.
I'm also on the board of Ripple, which is XRP, cryptocurrency. But I want to make something very, very clear. Blockchain is here to stay. The train has left the station. You're going to hear me quoted about that all the time. As far as I'm concerned, whether it's fractional real estate, whether it's art, whether it's NFTs, blockchain is not going away.
So where are you on all this, Uncle Frank? Well, this is not financial advice, and I am not a financial advisor. I will never tell you to buy, sell, or hold any security or cryptocurrency, but my retirement accounts are already on the sidelines. I'm not interested in chasing the S&P to 6,000 at this time. My speculative account is mainly what I discuss on this channel: AMC, Archer, GameStop, and the VIX. I'm hoping to see a resolution on my current trades before the end of October. XRP is the only crypto position I have, so I may speculate in other projects from time to time, but I have made my choice on XRP and crypto by putting my money where my mouth is. If we get a successful exit on the speculative issues I've mentioned here, I will be migrating those funds into precious metals: gold, silver, palladium, and possibly platinum. That's the plan, and I'll alert you if it changes. So let's do Archer Aviation first. Investor Place always gets it wrong. The stock did not pop on this news. The short interest was high. The institutional sponsorship was near 50%. It was quadruple witching Friday. Costs to borrow and days to cover were on the rise, and the market makers were smart to even out before the weekend. This headline may have helped, but it's pale in comparison to recent headlines, like the company getting its FAA certification and the stock barely budged, or new news on business with United Airlines and other carriers. Archer took off at the open and never looked back, so Investor Place is either stupid or lying or both as usual. Archer stock pops on San Francisco plans. Archer recently announced plans for an air mobility network in San Francisco. The company plans to build 5 locations in the Bay Area that can be easily traveled between via Archer's eVTOL aircrafts. Archer stock is up more than 15% on the news, although shares were still well in the red for the year. There's the 5-minute chart on Archer's great day from Friday. She started pre-market with a low of 312, vaulted as high as 370 to finish at 366, up 54 cents or 17.31%. She gave back 3 cents to finish the after-hours session at 363. I sold my $4 strike calls expiring July 5th for 100% gain, but held my $4 calls expiring October 18th. My average cost on the common is $3.20, and I'm excited about the future of the company and the stock. I'm not a fan of electric cars because Uncle Frank appreciates the sound of a good exhaust note. But this contraption is a winner, in my opinion, and has the potential to become an adverb like Google or Uber. In other words, you'll say, I'm going to Archer to the Hamptons this weekend, just like you say, I'm going to Uber to work today. Do you feel me? Okay, so let's check in with Yahoo's most shorted stocks screener. The region is set for the United States. Intraday price greater than $1. Average volume over the past 3 months greater than 200,000 shares traded. And the exchange is set for the New York Stock Exchange. I see 1,620 results. Let's check them out. So here are the results. GME in the 13th spot, Cinemark directly behind it in 14th, AMC is in the 25th position, and Archer is in the 38th spot. Here's the chart depicting the rise in short interest in Archer, but that's as of May 31st, where they're showing short interest of only 18.84%. I happen to know recent short interest was nearly 28% by the end of May. So how does Archer Aviation's short interest compare to its competitors? Well, Archer is the most targeted here at 27.85% according to MarketBeat. The next closest is Bark at 15%. The short interest ratio has also been on the rise. That's the days to cover. It's calculated by dividing the number of shares of a stock sold short divided by its average trading volume. A short interest ratio ranging between 1 and 4 generally indicates strong positive sentiment about a stock and a lack of short sellers. A short interest ratio of 10 or greater indicates strong pessimism about a stock. Archer shares currently have a short interest ratio of 11, and you can see on the table on the bottom the climb from 9.2 days to cover in mid-March up to 11 days to cover by the end of May. So which institutional investors are shorting Archer Aviation? Well, according to MarketBeat, it's Ionic Capital Management and Concourse Financial Group Securities. A closer inspection at Fintel.io reveals the put positions against the stock and a familiar list of assholes betting against innovation on a growth stock that barely has the ability to post any revenue yet. You know the names: Citadel, Susquehanna, D.E. Shaw, Bank of Montreal, Wolverine Trading, Hightower. Of course, this data doesn't show the June activity yet because our enemies are permitted to hide their trading. But thanks to payment for order flow, they know exactly how many we own and at what prices we paid. Don't forget, Goldman Sachs, for example, is permitted to mark 60 million short orders as longs for a fine of only $3 million. I find it encouraging that Goldman is on this list shaded in pink, which indicates they sold their puts on ACHR. One of the big reasons I think the shorts are making a mistake here is institutional ownership, which is knocking on half of the entire float at 47.58%. The best news I have for you from this weekend is at the time of this recording, I see only 15,000 shares of Archer available to lend and short, with a cost to borrow fee that's vaulted from 6.28% on Thursday to 24.38%. Okay, so you guys want my thoughts on AMC? You're not going to like them. We're a zombie company. And before you blame Kenny, I want you to know the only people that can convert your company into a zombie company is management. Zombies are companies that earn just enough money to continue operating and service debt, but are unable to pay off their debt. Such companies, given that they just scrape by meeting overhead like wages, rent, interest payments on debt, etc., are created by wild spending, in this example, like doubling pay plans during the pandemic, investing $250 million in green projectors, investing $1 billion in Saudi Arabia, and then bailing for $30 million, investing in bankrupt penny stocks to bail out short sellers of your own stock, spending $25 million on commercials that only air in the theaters, giving away shares of the company for free as a dividend. You guys know who I'm talking about, Adam Aron. We now are dead money without a black or white swan event. Maybe Ryan Cohen will announce what he plans to do with the $4 billion, and AMC may follow GME up. But that's where we're at for now, dead money. Maybe the box office will come back for the summer with Darkpool and Wolverine in late July, but Adam will surely sell into any rallies, and I doubt the Limit Up, Limit Down committee will stop protecting Wall Street. Adam could put the company over $20 per share Monday morning if he wanted to, in my opinion. He need only say he's done diluting at near record low stock prices under $1 on a pre-split basis, and will only dilute in the remainder of 2024 if it's an emergency. He will never do that, and I'll tell you why. A senior employee from Morgan Stanley runs our board of directors. Our CEO was a partner at Apollo Global for 9 years, just prior to running AMC. Our newest board member is also from Morgan Stanley and actually helped Apollo buy Outerwall and or Redbox while she was CFO. She doesn't hide it. She already sits on major committees at AMC and has zero liability as part of her employment agreement. I don't care if you guys call me a shill or accuse me of working for the hedgies. On the contrary, the people that told you the conversion and the reverse split were going to cause a MOAS, you need to go accuse them of that shit, not me. I told you the truth and still hodl to this day. I even bought more on Friday like an idiot, and I'll probably stand in line to buy another popcorn bucket. If you can't see the writing on the wall here, and that only a swan event can deliver us from this trade, please go follow Tony De Niro or one of those other YouTubers. You don't need a guy like me. Having said all that, if we do get a swan event, I would rather have top-line revenue on an upswing rather than a downswing, right? AMC stock alert. Inside Out 2 drives new 2024 record for AMC Entertainment. AMC Investor Relations Department completely silent, of course, except for this kind of news. AMC starts talks with lenders to cut debt and extend maturities. And then there's this shit. Netflix launches popcorn line to compete with AMC's. You're lucky I don't go over to Walmart and take a piss on the Netflix popcorn display. And finally, from Sunday in Missouri, juvenile arrested for using gel bead blaster in an AMC theater. A juvenile was arrested for firing a gel bead blaster into a crowded AMC theater, causing panic and fleeing the scene. Thanks, kid. That was the cherry on my Sunday. And a quick box office update from Variety. This past weekend, Inside Out 2 scores $100 million in sensational second weekend. And then, only in theaters, next Friday, Horizon with Kevin Costner. And then, only in theaters, Suck It Netflix, Despicable Me 4, July 3rd. And let's check out what's going on with the shorts. Vanishing short sellers have helped push stocks to record highs, but beware of a sharp negative reversal, JP Morgan says. Short sellers have been withdrawing, with bets against major indexes falling to record lows, JP Morgan said on Thursday. The bull market has crushed the shorts. That leaves stocks more vulnerable to bad news, says JP Morgan. Short positions in popular assets are at record lows, implying a bet that volatility will stay low. And then, Bitcoin. Short sellers are betting it will stay below 70,000. Bitcoin is once again at the center of the news. Short sellers, those traders betting on falling prices, are holding their breath hoping Bitcoin will stay below 70. Now you know what to root for. Followers of this channel will probably remember my feelings about SPPP, or the Sprott Physical Platinum and Palladium Trust. It may be off the threshold list, but after hours Friday, it spiked 7.28%. Something's going on. What do you suppose it is? And this slide goes out to Donahue George and CSI. We've got a CAT event coming up, industry testing checkpoint call, and industry member report card webinar, July 10th. For those of my listeners that stuck with me to the end of this video, I wanted to share an interesting tool with you called TradingView.com. What's useful about this site is you can quickly pull up some important reports about after-hours gainers and losers, new all-time highs or lows, or pre-market most active. If you want to know where the action is, this tool may help you find it. Let's click on After Hours Gainers. And there you go, top gaining U.S. stocks in the post-market from Friday. Why is EPOW, or Sunrise New Energy, up over 60% in its after-hours session? Let's click on Highest Cash. And there you go, U.S. companies with the most cash on hand. I thought it was going to be Apple at the top, but it's not. It's Berkshire Hathaway, then Google, then Amazon, then Microsoft. Did you know Interactive Brokers has more cash on hand than Apple does? Now you do. Hey, I want to thank you for watching, and please remember to hit the like button after this slide if you enjoyed the presentation. Subscribe to the channel and set the alert so you're notified when I have new information to share. See you at the bell.